Most people believe banks make money when you spend more. But that's not true. Banks make the most money when you stay in debt. Quietly, consistently, and for a long time. Every time you use a credit card, the bank collects data about you. How often you spend, how quickly you pay, and most importantly, whether you carry a balance from month to month. If you pay your balance in full, the bank earns almost nothing from you. But if you stay in debt, interest starts working against you. And that's where the real profit begins. In the United States, the average credit card interest rate is over 20%. That means if you carry a balance, you're paying the bank every single month. Not for new purchases, but just for borrowing money you already spent. This system isn't designed to help you get rich. It's designed to keep you predictable. The longer you stay in debt, the more valuable you are to the bank. Most people don't realize this because credit cards are marketed as convenience tools. Cashback, rewards, points, travel benefits. But those rewards only matter if you understand how the system actually works. Let's break it down. When you make a purchase with a credit card, the bank doesn't charge you interest immediately. Instead, they give you a grace period, usually around 30 days. If you pay everything back during that period, you avoid interest completely. In that case, the bank only earns a small transaction fee from the merchant. But if you don't pay in full, the balance rolls over. And that's when interest is applied. From that moment on, every day costs you money. Now here's the part most people miss. Credit card interest compounds. That means you're not just paying interest on what you spent, you're paying interest on the interest itself. Over time, this turns small balances into long-term debt. This is why banks love minimum payments. When you only pay the minimum, you stay in debt longer. And the longer you stay in debt, the more interest you pay. In many cases, paying only the minimum can keep you in debt for years, even if you stop using the card entirely. From the bank's perspective, this is perfect. You're not defaulting, you're not missing payments, you're just paying slowly. And slow payments are incredibly profitable. That's also why credit card statements are designed the way they are. They highlight the minimum payment, they hide the long-term cost, and they make debt feel manageable, even when it's not. Now let's talk about credit scores. Your credit score is not a measure of how wealthy you are. It's a measure of how predictable you are as a borrower. Banks want to know one thing. Will you pay them back? And will you do it consistently? That's why credit scores reward certain behaviors. Paying on time, keeping balances below your limit, maintaining long-term accounts. But here's the twist. Banks don't want you completely debt-free either. A customer who never borrows is hard to profit from. A customer who borrows responsibly is ideal. And a customer who carries manageable debt is extremely valuable. This is why people with perfect payment history can still be offered higher limits. Not to help them, but to encourage more spending. More spending increases the chance of carrying a balance. And carrying a balance increases profit. So how do you use this system without falling into the trap? The answer is simple, but not easy. First, never treat a credit card like free money. Every dollar you spend is borrowed. Second, always pay your balance in full. Not the minimum, not most of it. All of it. If you can't afford to pay it off this month, you can't afford it at all. Third, use credit cards for tracking and rewards, not for financing your lifestyle. Cashback only makes sense when interest is zero. Once you pay interest, rewards become irrelevant. And finally, understand this. Credit cards are tools. Dangerous tools if used emotionally, powerful tools if used intentionally. Banks make billions from people who don't understand the rules. You don't have to be one of them. If you control your spending and pay in full, you can build credit, earn rewards, and avoid debt entirely. That's how credit is supposed to work. If this video helped you understand the system better, subscribe for more finance breakdowns like this. Thanks for watching. Even people who believe they understand credit often underestimate how interest really works. A small balance doesn't feel dangerous. A few $100s turns into a few thousand faster than most people expect. That's because interest doesn't wait. It accumulates every single day. And when interest is added, your next payment goes mostly toward interest, not toward the original amount you spent. This is why many people feel stuck. They keep paying, but the balance barely moves. From the outside, it looks like poor money management, but in reality, the system is designed this way. Credit cards are structured to be easy to use and difficult to escape once debt begins. Another important detail most people ignore is how credit utilization works. Credit utilization is the percentage of your available credit that you're using. If you have a $10,000 limit and you're using $5,000, your utilization is 50%. High utilization signals risk to lenders. Even if you never miss a payment, your credit score can drop simply because your balance is too high. This creates a cycle. Your score drops, your interest rates increase, your payments become less effective, and once again, the bank benefits. This is also why balance transfer offers exist. They look like help. 0% interest for 12 or 18 months, but they rely on one assumption, that most people won't fully pay off the balance before the promotion ends. When the promotional period expires, interest is added back at full rate. At that point, the debt becomes even more profitable. Now let's talk about rewards. Cashback and points are not gifts. They are incentives. Banks calculate rewards very carefully. They know exactly how much they can offer while still earning profit from interest and fees. For disciplined users, rewards can be beneficial. But for emotional spenders, rewards become justification for unnecessary purchases. This is why many people spend more just to earn points they don't really need. In the end, the most important rule is this: credit should support your financial life, not replace it. If a credit card helps you track spending, build history, and earn small rewards, it's doing its job. If it creates stress, debt, or dependence, it's working exactly as banks intended. Understanding the system gives you control. Ignoring it gives control to someone else. That's the real difference. If you want to learn how to use financial tools without falling into debt, subscribe to the channel. More videos like this are coming. One of the biggest mistakes people make is thinking debt is normal. It may be common, but it's not harmless. Debt slowly limits your options. It affects where you live, what risks you can take, and how much control you really have over your time. That's why understanding credit is about more than money. It's about freedom. When you remove interest from your life, everything changes. Your income starts working for you instead of against you. Saving becomes easier. Planning becomes clearer. This doesn't require extreme discipline. It requires consistency. Using credit responsibly is not about being perfect. It's about being intentional. Before every purchase, ask one simple question. Can I pay this in full right now? If the answer is no, that purchase doesn't belong on a credit card. This single rule eliminates most financial stress. Banks will continue offering rewards, higher limits, and easy approvals. That will never stop. But once you understand the system, those offers lose their power. You stop reacting emotionally and start making decisions logically. Credit cards then become what they were always meant to be: tools. Tools to track spending, tools to build history, tools to create leverage without pressure. Not chains, not traps, and definitely not a lifestyle. If you take control of credit, you take control of your financial future. That's the difference between playing the game and being played by it. If this breakdown helped you see credit differently, subscribe to the channel. More clear, honest finance videos are coming.